All right, let's dive right in. Today, we're going to pull back the curtain on the stock market. You know all those wild swings up and down? We're going to follow the money, follow the big players, and figure out what's really driving the action behind the scenes. Ready? Let's do this.
So, have you ever just stared at a stock chart and thought, what on earth is going on here? It can look like total random chaos, right? Well, what if I told you there's a story hidden in all that data, that there's actually a map you can follow to see the strategy behind it all? That's exactly what we're going to unpack today.
Okay, first things first, we need to know who the real movers and shakers are. Think of the market as a giant ocean. You've got your small fish, sure, but then you have the whales. These are the massive institutional investors, and when they move, they make waves. Big ones. So who are these guys exactly?
Broadly speaking, they fall into two big categories. On one side, you have the FIIs, that's foreign institutional investors. This is the big money from overseas, hedge funds, international pension funds. Their moves are often tied to global trends. And on the other side, you've got the DIIs, the domestic institutional investors. This is the home team. We're talking about Indian mutual funds, insurance companies. Their decisions are usually more focused on what's happening right here at home. And believe me, both of these groups pack a serious punch.
Now, here's the cool part. These whales, they can't hide their tracks. Every single day after the market closes, we get a data dump that shows us exactly what they bought and what they sold. It's like a breadcrumb trail. And if you know how to follow that money, you get a fantastic read on the real mood of the market.
So when you see a table like this, don't get overwhelmed. The number you really want to focus on is the net value. It's super simple. It's just what they bought minus what they sold. Positive number, they bought more than they sold. Negative number, they sold more than they bought. That's really it.
So let's break that down. When you see a positive net value, what does that tell you? It's a sign of confidence. It means the big money is flowing into the market. They're optimistic. In trader speak, we call this bullish. It's a sign they expect prices to go up. Let's look at a real example here. See that number for the DIIs on Feb 20th? That's a positive 2,637 crores. That's not just a small purchase. That's a huge vote of confidence from the domestic players. They were buying with conviction that day. And of course, it works the other way too. A negative net value? Well, that means the big players were selling off more than they were buying up. Money is flowing out of the market. This points to pessimism, or what we call bearish sentiment, the expectation that prices are headed down.
And whoa, look at this example. On February 13th, the FIIs, the foreign money, pulled out almost 7,400 crores. That is a massive amount of selling. When you see a number like that, it's a huge red flag, a really clear bearish signal for the market on that day. Okay, so tracking the daily money flow is like getting the morning newspaper report. But what if you want to see the battle as it's happening, live? For that, we turn to our next major tool, the option chain. Seriously, think of this as the real-time battlefield map of the market. It's where all the action is.
So what is this thing, the option chain? It's basically a big table that lists all the bets, called options, the traders are making on a stock or an index. It looks complicated, but we're just going to zero in on a couple of key things to understand the fight.
First up is the strike price. You can think of these as the specific price levels on our battlefield map. These are the lines in the sand where traders are placing their biggest bets.
And this brings us to the most important piece of the puzzle, open interest, or just OI. This number tells you how many contracts or bets are currently open and active at each of those strike prices. A really high OI at a certain level, that tells you that's where the big money is paying attention. It's a hot spot.
And this is where it all comes together. By looking at where the open interest is highest, we can literally map out the front lines of our battlefield. We can see the major defensive positions where traders call support and resistance.
Okay, rule number one. When you see a huge amount of open interest on the call side at a certain strike price, that level tends to act like a ceiling. Traders call this resistance. It's like a wall that the price will struggle to break through.
And rule number two is the exact opposite. A huge amount of open interest on the put side acts like a floor for the price. This is called support. It's a level where a ton of traders are betting the price will not fall any further. I think the best way to picture this is to think of them as digital walls. These are massive walls built by traders' money. A giant wall of call OI sitting above the price acts as a resistance ceiling, and a giant wall of put OI below the price acts as a support floor. These walls show you exactly where the big players are defending their positions.
Let's look at this simplified example. See it? At the 25,700 strike price, you have a massive 223,000 in call open interest. That's our resistance wall, our ceiling. Now look down at 25,500. See that huge put open interest of 180,000? That's our support wall, the floor. So based on this data, the market is most likely going to be bouncing around between these two giant walls.
Okay, so we've got the daily report from the FIIs and DIIs, and we've got our live battlefield map from the option chain. Now for the million-dollar question. How do you actually use all this stuff to create a smart plan? Well, analysts typically use a pretty straightforward three-step approach. Step 1, you identify your key levels. You use the FII/DII data to get the overall mood, and then you use the option chain to pinpoint those exact support and resistance walls. Step 2, you plan for different scenarios. You ask yourself, okay, what's my play if the market opens way up, way down, or just stays flat? And step 3, which is honestly the most important thing, is you manage your risk. This is not about being a fortune teller, it's about being prepared and protecting your capital, always.
And building a good plan also means knowing what not to do. Look, a lot of people make the same mistakes. They might ignore open interest, or they'll get fixated on just one single indicator. Big mistake. Or they'll trade where there's no volume, or just forget about big news events. And the biggest sin of all, not using a stop loss. You have to combine these tools and be disciplined to get the full picture.
So really, what's the big idea here? It's that the market isn't just random chaos. There's a logic to it, a strategy playing out every single day. And by learning how to read the data trail left by the big institutions, you can start to see that chaos for what it really is, a strategic map. You get to see where the big money is moving and where the major battles are being fought.
And that's really what it's all about. This isn't secret information. This data is available to everyone every single day. So the real question is, now that you know how to read the map, what story is the market telling you today?